Assalamu alaikum everyone. This question is from February March 2021. This question is question number 5 of that paper, and this is from incomplete records. The question says here, Myra opened up a shop on 1st January 2020. That means it's her first year of trading is 2020. She provided the following trading information. So they are saying here gross margin is 40%. So 40% gross margin means gross profit as a percentage of revenue. So gross profit is 40% of the total revenue of the business, And then they are saying purchase price. So the units that she's selling, she's making a revenue out of. The inventory that she is selling is the purchase price of one unit of inventory is $70. So the transportation that she's paying for this one unit of this inventory is $2 per unit. And she's saying here inventory at the end, that is 130 units at 31st December 2020. So we have 130 units as closing inventory at 31st December 2020. So here they're saying calculate the cost of Myra's inventory at 31st December 2020. So the purchase price is $70. So one unit is for $70, the cost of it, plus the $2 carriage inwards is that the transportation that Myra is paying to bring the inventory to her warehouse. So 72 is basically the purchase price in total. When you multiply, this is $72. So 72 multiplied by 130 will be our cost of inventory at the end of the year. So 72 multiplied by 130 is 9360. So the formula that I have applied here, cost price per unit multiplied by number of units in inventory. So I got the cost of inventory at the end of the year. Then they are saying here, Myra has not kept a full set of accounting records, but provided the following information. All sales were made on cash terms. The sales for the first year sales were, for the first 2 months, 10,800 each month. So 10,800 multiplied by 2. So in the next part, they are saying they're in part A, in part B of this question, they're asking you to make the income statement. So you need to calculate total sales to actually start the income statement. The first value in the income statement is revenue. So you write here 10,800 multiplied by 2. Also 12,000 for the next 8 months. So 12,000 multiplied by 8, 16,200 multiplied by 2. So you get here 3 values that are for revenue for this year. So the first value here will be 21,600. The second value here will be 96,000. And the third value here will be 32,400. And all of these, when you add these up, you get 150,000. All of these, when you add these up, you get 150,000. This is my total revenue in this question. Then they are saying during the year, Myra purchased 1,400 units. Carriage was paid on these units. So 1,400 into 70 is my purchases, 1,400 into 70, and 1,400 into $2 is my carriage inwards. So 1,400 into 2 is 2,800, 1,400 into 70 is 98,000. So my purchases is 98,000 and my carriage inwards is 2,800. So if I make my, so I know my closing inventory as well. This is 9360. My purchases is 98,000. Carriage inwards is 2,800. I know my total revenue, that is 150,000. Then they are saying Myra took goods from the business during the year ended 31st December 2020. No record was kept of these drawings. So we don't know how much is drawings of goods. Drawings of goods is there in the cost of goods sold section of the income statement. So we'll just start the income statement and try to figure out what drawings of goods are here. Revenue will be 150,000. Then I'll write here less cost of sales. Then I'll write here purchases. I don't have an opening inventory because this is the first year of trading for Myra. So I write here purchases 98,000. Then I write here add carriage inwards. That is 2,800 here. Carriage inwards is 2,800 in this question. Then I write here less drawings of goods. And I don't know what is the amount for drawings of goods. We don't know this. In the question, they haven't said anything clearly. They don't have any record of how much was drawings of goods. But I will eventually find it out. So whatever the value comes out to be, I need to subtract closing inventory from this. So I'd write here less closing inventory. And closing inventory here is 9360, which I have calculated in the first part of the question. And then I need to now use my margin to actually find out the drawings of goods. So when I use my margin, I'm going to find out the gross profit. So whenever margin is given, so revenue is 100% when margin is given. Gross profit here is 40%. And cost of sales, of course, if revenue is 100% and gross profit is 40%, so revenue minus cost of sales is equal to gross profit. So if gross profit is 40, cost of sales is X, revenue is 100, so X is equal to 60%. So cost of sales is 60%. So if I take out my 40% of the total revenue, I'll get gross profit. So 40% of 150,000 is 60,000. Similarly, 60% of 150,000 is 90,000. 40% of 150,000 is 60,000. 60% of 150,000 is 90,000. But if I have gotten my gross profit, 150,000 is my revenue, gross profit is 60,000. So revenue 150,000 minus 90,000 will give me 60,000. So I know my cost of sales is 60,000 here. Sorry, my cost of sales, I know my cost of sales here is 90,000. So I get 90,000 here. So when I calculate backwards, so this must be 99360 if I'm calculating backwards. So 90,000 plus 9360 is going to give me 99360. And here you need to find this out. So when I add these two, so purchases and carriage inwards, the addition of it will be 100,800. And then when you subtract 100,800 and 99,360, you get 1440. So for 1440 is my drawings of goods, which I have taken out through this trading section of the income statement. Also, one more thing to inform you guys, trading section of the income statement is always still the gross profit. And then after that, it's the profit and loss section. But till gross profit, it's my trading section. I'll write here gross profit. Okay. In the next part of this, they are saying Myra has been too busy to keep a full set of accounting records. However, she is now considering using double entry bookkeeping for her business. Advise Myra whether or not she should start to keep a full set of accounting records. Justify your answer with 2 advantages and 2 disadvantages. So advantages of using double entry records is that she'll have she'll have all the details of all the assets, liabilities, incomes, capital, expenses of the business, and it will be very, very straightforward to make the income statement and the statement of financial position. So she'll have full details of assets, liabilities, incomes of the business. Also, making the financial statements will be relatively straightforward. So making financial statements will be relatively straightforward for her. So it'll be easier to make financial statements for her. Also, her calculation of profit or loss will be more reliable and more accurate if she uses double entry bookkeeping records. Also, there will be less chance of fraud because she's maintaining all the information. She's recording every transaction of the business. Also, the disadvantage would be that it is time consuming. So maintaining double entry records would be time consuming. And if she doesn't know it herself, she'll have to hire an accountant. So she will have to hire someone to maintain double entry records. Also, if she hires someone, that'll be an additional expense of the business. So she'll have to pay them. So profit will reduce because of that. Also, if she doesn't hire someone, then she has to learn double entry bookkeeping herself, which can be very, very time consuming. Oh, okay. So then you give the recommendation. My recommendation would be that she should use double entry records, because that's the ideal way of maintaining everything in accounting. And if you're doing a business, you need to have record of every transaction that you're doing. The recommendation should be, yes, she should maintain double entry records. Then in part D, they're saying place a tick in the correct column to indicate to Myra the book of prime entry in which each of the following transaction would be recorded. So if you receive a discount from a supplier for prompt payment, that is recorded in the cash book, because discount received is a column in the cash book, and it cannot be recorded in the purchases journal. It cannot be recorded in the purchases returns journal. Discount received is a cash discount. It's a discount that is received at the time of payment. Whenever we are paying the supplier, at that time we receive this discount, that is cash discount, and cash discount received is one of the cash discounts. So cash discount is always recorded in the cash book. There's a discount received column in the cash book. Credit note received from a supplier. So whenever you're receiving a credit note, so there's one thing that is called debit note. Whenever we are returning goods to our supplier, we issue a debit note to our supplier, and we request the supplier to reduce the amount of the original invoice. So whenever the supplier is the seller, so when the seller receives all the goods, with the debit note, he inspects the goods and see if he should accept the returns or no. And whenever he accepts the returns, so when he accepts the returns, he confirms and issues a credit note. And then when he issues a credit note, so whenever we are receiving a credit note, we are going to record that in the purchases returns journal. We are receiving a credit note because we returned the goods to the supplier in the first place. So credit notes received will be recorded in the purchases returns journal. Direct debit paid to a supplier is again a payment made to the supplier, so that should be recorded in the cash book. Okay, in the last part, they're talking about accounting objectives, and accounting objectives is also a very small part of the whole syllabus. It says complete the table by placing a tick in the correct column to indicate to Myra the accounting objective which is described in each statement. So Myra's financial statements should be free from significant errors. So that means Myra's financial statements should be reliable. So if there are no significant errors in the financial statements, that means whatever information is presented to us is more reliable, is more accurate. In the next bit, they're saying Myra's financial statements should be provided in time for her to use them when making decisions about her shop. So the financial statements should be provided in time. So that should be the concept here. The accounting objective here is relevance. Relevance means that whenever it is relevant for your for the viewers of your financial statements, you have to issue the financial statements at that time. So if it's a limited company, let's say, so annual reports and annual accounts should be published at that time when it is relevant for the investors. So whenever we are expecting investors to invest more, there should be information available for the investors to actually so that they can assess the performance of the business and then invest the money. So that's it. There are basically 4 accounting objectives: comparability, reliability, relevance, and understandability. So these 4 are also tested in the MCQs sometimes, but this is a very small portion of the paper. So thank you so much for watching.